Welcome to StaalX Construction and Steel Podcast. Episode 6, Planning and Stress Data Point to Short and Long-Term Health of Construction. Before we start, a quick shout out to StaalX, the smarter way to source steel. Whether you're buying rebar, wire rods, or mesh, you can now get instant pricing, make an offer directly online, and track your orders, all in one place. Check out our new walkthrough video, How to Use StaalX, and see how easy it is to get started at StaalX.com.
Welcome to the deep dive. So right now, the news cycle, it's just full of economic static, isn't it? Ongoing budget uncertainties, maybe even a continuing federal government shutdown, noise that usually signals contraction, maybe fear. But if we kind of push past the daily headlines and really zoom in on the core data, specifically from the construction and steel markets, the signal we're getting is, well, surprisingly optimistic, especially looking out toward 2027. So our mission today is to really dig into those forward-looking reports. We want to figure out why some very specific sectors seem to be acting like a complete firewall against all these headwinds, and what does that actually mean for construction down the road?
Exactly. And we've lined up the key indicators here. We've got the planning data that tells us where investment is heading, a year or more out. And we're putting that alongside real-time sentiment from the steel supply chain. And what emerges is, well, it's a really fascinating picture. It's not a broadly healthy market, let's be clear. But it is profoundly resilient in these very specialized pockets. And it seems to be almost entirely down to the sheer scale of AI and digital infrastructure investment.
Okay, let's start there then. With the essential crystal ball for the industry, the Dodge Momentum Index, the DMI. Now, for us, the DMI is key because it tracks non-residential projects right when they enter planning. It gives us a pretty reliable forecast for actual construction spending about a year later. So what's that crystal ball telling us right now?
It's glowing pretty intensely, actually. So the DMI itself increased 3.4% in September 2025. That's solid on its own. But you really need to look at the trend lines. Overall planning activity. It jumped a massive 60% compared to September 2024. 60%.
60.
Yeah. And the index level right now is 33% higher than this time last year. And that's, well, it's not just growth. It feels more like exponential acceleration in planning.
That is a staggering jump. So, okay, if the DMI really does forecast activity a year out, what's the timeline implication for all this new planning? When does the dirt start moving?
Well, that's what's so interesting. This level of sustained momentum in planning, it points directly to stronger construction spending hitting in early 2027. It's basically suggesting that 2027, or at least the start of it, could really be the high watermark for construction spending in this current cycle. That optimism is already kind of baked into the pipeline now.
Okay, but we need to unpack the drivers here. Because, it can't be a broad-based boom, right? Not with interest rates still being, well, elevated. You mentioned it's concentrated.
Highly concentrated, primarily in the commercial and institutional segments. And within commercial, that's where you see the really crucial detail. The growth is leaning heavily, almost entirely on data center projects. What we're seeing is that this AI infrastructure build-out, it isn't just surviving the economic uncertainty, it's acting like a sort of non-correlated firewall for the whole construction planning sector.
Wait, hang on. So if you pull out that specific AI bubble, just the data center projects, the rest of the commercial planning market is basically flat.
Precisely. Yeah. Without those specific data center projects hitting the planning stage in September, a commercial planning would have only nudged up, maybe 0.5%. Just 0.5%.
Okay.
So that makes the big 60% year-over-year jump look incredibly specialized. Now, on the institutional side, the growth was more from healthcare, like hospitals and some public buildings, but other areas like education, recreation projects, they actually softened a bit.
And it's the sheer scale of these projects that really inflates the index, right?
Yeah.
We're not talking small tech upgrades.
No, not at all. These are massive, high-value projects. Look at what's entering the pipeline just in that 1 month. You've got a $440 million Cyrus Zone data center in Illinois.
$440 million.
Yeah. And a $384 million Meta data center, Phase 2, down in Alabama. Huge numbers. And that contrasts a bit with the institutional side, which still has big projects like a $227 million HCA hospital in Texas. But the scale of the data centers is just enormous right now. These mega projects are really defining the resilience we see in the forecast.
Okay, so if we have all this high-value planning pointing towards a strong 2027, the next big question has to be, are builders actually able to execute? Are they too stressed by costs, labor shortages, all the uncertainty? That brings us to project viability, right? The Construct Connect Project Stress Index, the PSI, what's that showing?
Well, there's some positive news there, definitely pointing towards stabilization. The PSI actually declined for the third month running in September. It dipped about 0.6% from August. Importantly, bid date delays fell 3.8%, and project abandonments dropped quite a bit, 9.6%. So overall stress, it's only about 4% above the 2021 baseline. It suggests the market is maybe learning to cope with the volatility better.
But looking at the data, that stabilization isn't across the board, is it? It looks like there's a really critical split emerging, a frankly worrying bifurcation between private sector projects and public sector ones.
Yeah, this is where that specialization theme becomes really stark. Private construction is showing deep resilience. Private project abandonments actually fell 8% year over year,
Okay.
and projects put on hold, that dropped a huge 54.5% compared to the same time in 2024. So the private money, I think the AI money, the healthcare money, it seems locked in. It's pushing forward despite everything.
But the public sector, that seems to be weakening quite intensely, which, that should worry anyone thinking about public infrastructure, schools, local projects. Public abandonments climbed almost 17% year over year in September.
That's right, 16.7%. And public projects put on hold jumped 5.8%.
Yeah.
So yeah, you've got the private sector running ahead, funded by these AI mega projects, while the foundation, our public works, seems to be grinding to a halt.
And the reason for that public sector pain seems pretty clear.
Oh, it's unambiguous in the report. It's disruptions directly from federal funding cuts, issues tied to the pause on the Infrastructure Investment and Jobs Act. It's really hitting hard. And we absolutely have to remember this data only runs through September 2025. The full impact of the federal shutdown that started October 1st. That's not even in these numbers yet.
Good point.
So we should probably anticipate those public abandonment and delay numbers will look, well, worse in the next report, potentially much worse.
It's just such a vivid illustration of how funding stability really determines viability, isn't it? I mean, you still have broad challenges. Nearly half of contractors still cite labor shortages as a major hurdle. But if you've got the funding security of a, say, $400 million data center, you find a way forward.
Exactly.
But if you rely on uncertain public grants, you might just be forced to abandon the project.
That's the split we're seeing.
Okay, let's connect the dots then. This concentration of construction into these massive specialized AI builds, it has to be sending ripples through the supply chain. How is this specific demand affecting a critical material like steel? Let's bring in the StaalX market report.
Right, and what's fascinating here is the surprising resilience in what they call the long products market. Now that's crucial because long products, that means structural steel, rebar, wire rod, beams. The stuff that actually builds skyscrapers, bridges, and critically, the huge shells for these data centers. So the StaalX report directly cites the surge in AI-related data center investments as the main reason the fourth quarter, which is usually quieter for steel, is staying robust for these long steel producers. You've got this consistent, high-volume domestic demand, and it's largely supported by high trade barriers keeping imports out. So it's creating a very, very favorable environment for the domestic mills right now.
And favorable is definitely the right word, especially when you look at their bottom line, right? Raw material costs, scrap prices, they're actually declining.
Exactly. So that creates this highly advantageous situation for the mills. You get a wide scrap-to-product spread, as they call it. Meaning when scrap costs go down, but the price they sell finished steel for stays high or even goes up, that wide spread is basically pure profit margin for the mills. And they're running at full capacity right now to capture that.
So that financial confidence, that must be translating into their pricing decisions.
Absolutely. It's leading to some pretty bold price action. We just saw several U.S. merchant bar producers announce a sharp price increase, $40 per short ton.
And merchant bar is?
Merchant bar is the smaller, kind of non-structural steel. It's used in more specialized fabrication, things like the racks, the specialized interior structures you need inside facilities like data centers.
Oh, okay. Makes sense.
So the market's now watching Nucor, who's the big leader, to see if they follow suit with that price hike. And analysts think it's a strong possibility, just given the clear demand strength coming specifically from this AI build-out.
So let's recap. We've got a federal shutdown, possibly ongoing broad economic uncertainty swirling around. But the part of the steel sector focused on construction is confident enough to raise prices and run at full tilt.
It perfectly sums up the highly specialized nature of this boom, doesn't it? The shutdown so far has had a really minimal impact on actual steel consumption. The momentum, particularly from the AI and data center construction, it's just strong enough to completely offset the drag from the public sector uncertainty. And the expectation is that this momentum can carry the industry forward until at least the middle of next year.
So if we synthesize this whole deep dive for you, the listener, what you're seeing is this highly selective, almost non-correlated boom in construction planning. The overall outlook for construction going into early 2027 looks surprisingly strong. But, and this is the critical but, that strength is being almost entirely driven by these niche, high-investment sectors. Data centers, followed by healthcare. Meanwhile, your public projects, broader infrastructure work, they're lagging significantly. Funding instability, high costs. It's holding them back. We are literally watching the physical construction of the future AI economy rise up, even while parts of the current economy's foundations seem to be struggling.
That really is the big picture. But there was a key takeaway, maybe a cautionary note, in that Dodge forecast. They mention that while planning is incredibly high right now, they expect that activity to normalize in the coming months.
Thank you for listening. Explore more at www.staalx.com.